A record amount of silver just left the West and got on a boat. It is not coming back. And almost nobody on the financial channel said a word to you about where it went or why it matters to the number you see when you check the price of silver. So let me talk to you straight, because this is about your money. If you own silver right now, or you have been thinking about it, the price on your screen is set on an exchange in New York. And that exchange just got a little emptier. Quietly. In a way that most people watching the Daily Tick will never notice until it is far too late to matter. Here is what I am going to give you in the next few minutes, and I am going to give it to you honestly. By the end of this, you will understand the single thing that separates a buyer who pushes the price around for an afternoon from a buyer who can crack the whole machine underneath it. It is not how much money they have. It is one specific choice they make. And once you see it, you will never look at the silver price the same way again. And there is one number I want you to hold in the back of your mind, because it is the number this entire story is really about. It is not the price. It is a number buried inside that New York exchange that tells you exactly how close this is to the edge, and I am saving it for the last few minutes on purpose, because it is the part Wall Street and the financial media will never, ever put on your screen. Stay with me, and you will walk away with it. Now, let me show you the clue, because this whole thing starts with a clue that hid in plain sight. Over the past stretch, China pulled in a record haul of physical silver. Not paper silver, not a bet on a screen. Actual metal, refined and stacked on pallets, imported at a pace far above anything it normally runs. At the same time, the vaults in Shanghai got drawn down hard enough that at the stress point silver inside China was trading at a real premium to the price in London. And when the price inside a country runs above the world benchmark, that is not a rumor and it is not a headline. That is a magnet. Metal gets physically pulled toward wherever it is worth more, out of Western vaults, onto ships, into China. Follow that with me for a second, because this is where it gets interesting, and this is the thing the West keeps missing. Everybody stares at the price. The price went up, the price went down, silver had a rough patch, silver bounced back. And yes, silver just came through a hard shakeout, knocked down into the mid-50s in a fast, ugly flush before it clawed its way back above 60, and gold has pushed back over 4,100 to a multi-week high with a lot less drama. That is all real, and if you held silver through that drop, you felt every minute of it. But the price is the scoreboard. The clue is not on the scoreboard. The clue is in the cargo hold. Because a determined buyer taking physical metal off an exchange does something to that exchange that no amount of betting on the price can ever do. And to understand why, I have to take you back about 45 years to two brothers from Texas who figured this out the hard way and paid for the lesson so you do not have to. Go back to the end of the 1970s. Meet Nelson Bunker Hunt. His father had been one of the richest oil men in America, and Bunker had inherited both the fortune and a deep, bone-level distrust of paper money. He watched the dollar being cut loose from gold. He watched inflation eat into everything, and he came to one conclusion that, it turns out, was completely correct. He decided that paper promises were going to fail, and that the only thing worth owning was the real, physical thing you could put your hands on. So he and his brother started buying silver. But here is the part that matters, the part that is the whole point of this video. They did not just buy contracts and sit there hoping the price would rise. They took delivery. They demanded the actual bars. They pulled the metal out of the exchange and had it shipped away, some of it flown out of the country entirely. Now, think about why that terrified the people running that exchange. When you buy a silver futures contract, in the normal course of things, you are not really asking for metal. You are making a bet, and when the bet is over, you settle up in cash. And the same pile of physical silver sits in the vault, backing thousands of these bets at once. That is the quiet assumption the entire paper market is built on. Almost nobody actually shows up asking for the bars. The system works precisely because you do not take delivery. But the Hunts did. They stood there and said, "We do not want your cash. We want the silver. Hand it over." And every time they did, the deliverable pile in that vault got smaller. And silver went from single digits up toward $50 an ounce. And the gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, compressed all the way down towards 17, a level it had not seen in generations. They were right about the scarcity. Provably, historically right. So how does the story end? Not the way right should end. Because when the deliverable metal started running dangerously thin and the exchange realized the physical could not cover the claims, the people who run the market did not tip their hat to the men who had called it correctly. They changed the rules. The exchange brought in what became known as Silver Rule 7, which restricted buying silver on borrowed money, and in effect turned a market where you could only buy into a market where you were being forced to sell. The hunts were leveraged, and when the rules flipped under their feet, the price collapsed, and they got hit with a margin call north of $100 million. They were destroyed. Right about the metal, and destroyed anyway. I want you to sit with that lesson, because it is the one that protects you. A claim is not the metal. Being right that silver is scarce did not save them, because what they were holding at the leveraged edge was a paper position that somebody else got to redefine. The people who came out of that era whole were the ones who owned the physical thing outright, free and clear, that nobody could rewrite the rules on. And that is exactly where this touches your life, right now, today, at your kitchen table. Because if you are sitting on $100,000 or more in a retirement account, a 401k, an IRA, anything you spent a working lifetime filling, this distinction between owning the real thing and owning a promise on it is not academic. It is the whole ballgame. So let me stop for a moment and give you something practical. I put together a free retirement protection guide that walks through, in plain English, how some retirees are moving a portion of their savings into physical gold and silver, metal they actually own, held inside the tax-advantaged account they already have, without triggering taxes or penalties to do it. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And if you go through it and you want to talk it over with a human being, there is a free, no-obligation, one-on-one educational session for folks with $100,000 or more in any retirement account. No pressure, nothing to buy, just straight answers. All right, now let me get back to the clue, because we have only seen half of what makes it dangerous. Okay, here is the part that actually changes everything, and almost nobody connects these two stories. Watch this. The Hunt brothers were two men, wealthy men, but two men, using borrowed money, exposed to a margin call, vulnerable to exactly the rule change that took them down. Now look at who is standing at the delivery window today. It is not two brothers for Texas. It is a nation running an enormous trade surplus, sitting on a mountain of dollars it would rather turn into hard assets, buying with cash, not leverage. And you cannot send China a margin call. There is no rule the New York Exchange can pass that forces a country with a surplus to sell metal it paid for outright and shipped home. The single weapon that destroyed the Hunts, the leverage, the borrowed money, the vulnerability to a rule change, does not exist here. This is the Hunt brothers' delivery play, run at national scale by a buyer with no pressure point. And there are two engines driving it, and both of them are durable. Neither one is going away. The first is simple. Gold got so expensive that ordinary savers, priced out of gold, rotated into silver as the affordable hard asset, the poor man's gold. And in a country with over 1 billion people, that is an ocean of demand landing on a very small market. The second engine is industry. Solar panels, electronics, the whole electrification build-out runs on silver because silver is the best electrical conductor there is, and Chinese manufacturers have been scrambling to lock up physical metal, partly racing ahead of a change to their own solar export rules. Retail savers pulling on one end, industry pulling on the other, and the same limited pile of metal in the middle. Now, here is why this points straight back at the number on your screen, and why the West keeps looking at the wrong thing. Silver has run a structural deficit for 6 straight years now. The world uses more silver than it mines, year after year after year, and it has plugged the gap by draining above-ground vaults, hundreds of millions of ounces pulled down to cover the shortfall. And silver supply cannot simply answer the call, because most silver is not even mined on purpose. It comes up as a byproduct of digging for copper and lead and zinc. Nobody opens a mine because silver got expensive. So when a determined buyer keeps taking delivery, keeps pulling the physical metal off the exchange and out of the West, the deliverable pile does not refill on command. It just gets thinner. And a thinner and thinner stack of real metal is sitting underneath a paper market that has sold the same ounces over and over to people who all assume, like the exchange always assumed, that nobody is really going to show up and ask for the bars. Except somebody is showing up every single month. And that brings me to the number I promised you at the very top, the one that matters more than the price. On that New York exchange, there is a category of silver called the registered inventory. That is the metal that is actually available for delivery, the real bars that could be handed over if the people holding contracts came and demanded them. And sitting on top of that registered pile is a mountain of paper claims, contracts representing many, many times more silver than there are actual bars to deliver. In quiet times, that is fine, because almost nobody stands for delivery. But the ratio of paper ounces to real deliverable ounces is the number. That is the crack in the foundation. That is the thing that tells you how close the whole structure is to the moment the hunt's created by accident, the moment when too many people want the metal and there is not enough of it in the vault to go around. And that is precisely the number the financial media will never flash on your screen, because the price looks calm right up until the second it does not. And by then, the metal is already gone. It is on a boat. You already know where it went. Now I have to be the honest voice here, because that is the only kind worth listening to. Does the fact that China is draining physical silver mean the price goes straight up from here? No, I cannot promise you a price, and I cannot promise you a date. And the moment anyone hands you a specific number and a timeline, you should close their video and never come back. Silver is the single most violent major metal there is. You just watched it flush into the mid-50s and snap back above 60 in a matter of days, and it can turn right around and do the ugly version just as fast. In the short run, the price does not answer to the deficit or to China. It answers to the Federal Reserve, which under Kevin Warsh has turned hawkish, with a rate hike on the table instead of a cut. And metal that pays no interest always struggles when rates threaten to climb. It answers to the dollar. It answers to fear, and to whatever the paper market feels like doing on a given morning. The physical shortage is the trend. The Fed and the dollar are the weather, and the weather can soak you for a long, long time before the trend ever shows up at your door. Being right and being early feel exactly the same while you are holding through the pain, and only one of them ever pays, and only one of them ever pays. So when you hear the loud voices, and you will, put every number they throw at you through that filter. There is a real case made by a growing number of serious analysts that silver is deeply undervalued. When they run the arithmetic, taking gold near where it sits now and asking what silver would be worth if the stretched gold to silver ratio simply compressed back toward levels it has actually visited in the past, the numbers they reach sit well up in the triple digits, and the boldest of the bank forecasts run higher still. That is the math these forecasters put on the table, and the physical drain we have been tracking is one of the reasons they make it. But it is a case, not a promise. And out at the far edge, you will hear people calling for four-figure silver on the back of a full monetary reset. I am not going to insult you by pretending that comes from the same solid ground as the rest. The bigger the number, the more it is assumptions stacked on assumptions, and the more skepticism it has earned. I am telling you why they argue it, so you understand the whole spectrum, not because anyone alive can hand you that price or a date it arrives. So here is what to actually do with all of this. And this is not advice. It is just how a calm person thinks about their own position after sitting with the Hunt brothers story. First, and this is the one the whole video has been building toward, own the metal, not the promise. The people who survived that era whole were the ones holding the real thing that nobody could redefine underneath them, not a leveraged claim someone else controlled. Second, size your position so a shakeout like the one that just happened cannot force your hand. If a drop back into the 50s would force you to sell at the bottom to cover a bill, your position is too big, no matter how right the thesis is, because being forced to sell in the valley is how right people still lose everything. And third, never sell into the shakeout. The shakeout is the machine that transfers metal from the people who panic to the people who own. Do not be the fuel. The Hunts got shaken out by a rule change. Do not get shaken out by your own nerves. If you are on your TV, the QR code is on your screen one more time. If you're on your phone or your computer, go to jeffreedguide.com. It costs you nothing to be informed, and here is the only honest reason to look now. Not fake urgency, but the plain truth that the time to think a decision like this through calmly is exactly when nothing feels like an emergency, which is right now, not the day the vault runs dry and everyone panics at once. And for those of you who stayed with me all the way to the end, here is something just for you. If you have $100,000 or more in any retirement account, and you mention that you watched this full video, you can claim a free, one-on-one, no-obligation educational web conference, a real conversation about the difference between what you actually own and what you only think you own. No pressure, nothing to buy. That is for the folks at that level who made it all the way here, and you are one of them. So let me answer the question this whole video started with. Will that exchange in New York actually feel it now that China is pulling record physical silver off of it? Yes, it will. And now you understand why. In a way, almost nobody around you does. Not because of the price, which can be pushed up and down in seconds by people who never touch an ounce of metal, but because taking delivery is structurally different from placing a bet. And two brothers from Texas proved that 45 years ago with borrowed money and got destroyed for being early. China is running the same play with a nation's surplus and no margin call anyone can send. The metal is leaving. The deliverable pile is getting thinner, and the paper claims stacked on top of it have not gone anywhere. That record haul of silver got on a boat, and it is not coming back. The question is not whether the exchange feels it. The question is whether you understood what it meant before the calm broke, or after. You just did it before, and that is the whole advantage.